appreciate the introduction, Don. It's always awesome to have you start. So I'm the last. I know I'm the last speaker of the day. Hopefully I won't put everyone to sleep, but I love this presentation. And to be honest with you, this is kind of like a 5-hour presentation condensed to in 1 hour, and now it's recondensed into 30 minutes. I don't know if we can get through all of it, but we start with the most important thing. So Rethink is really one of the great value propositions that Sun Life have for you. Everything I talk about today, it's there in PDF for you on our advisor site on Sun Central. So if you scroll your mouse under consulting and you can click the little button on your screen, it's called Rethink. Everything I talked about today is there. It's written by our team of actuaries. And I know you just heard Nitin, but it's kind of tough to follow his act, to be honest, but I'll do my best. But it's written by our actuaries in our product department. Everything is there. It really encourages everyone to take a new perspective when you talk about product. We're going to go in depth, and also we're going to try to basically help you rethink it. The definition is in the word, and hopefully throughout this presentation, it can generate some ideas and some conversation starters that you can have with your client. So that's really the goal today, is to generate ideas, generate conversation. I'm going to click on the Q&A. I'll try to answer as I read through the Q&A as I present. So feel free to shoot me questions. And here we go with our first Rethink thought of the day. So the first chapter, if I can call it that way, that I'm going to talk about is regarding liquidity of life insurance. And the reason I want to bring this up is because a lot of people get confused on a few ways you can access cash value in your permanent life insurance policies. And it's not just that. I want to bring something up later in this presentation, is the big changes we got from G2 policies to G3 policies. And especially when it comes to ACB, and you'll see it at the very end when I run the numbers, you'll see the effect on it. So when you have a permanent life insurance policy, what are the ways to access the cash value if it comes with cash value, right? But most recently, I don't see a lot of T100s with no cash value. Normally, permanent insurance, either your whole life, your UL, or your par whole life, usually they all come with cash values. So the first and most simple way is there's a possibility to do policy withdrawal, right? It's most cases, I have to say most cases, it's contractually offered. And basically a withdrawal is treated as a partial surrender of the policy. So bear in mind, withdrawal is partial surrender, and later on you'll see how that affects how your taxation is calculated. The second way that you can access cash value is through a policy loan. It's contractual, and with Sun Life, you can borrow actually up to 100% of your cash value minus 1 year of interest. And our interest, we usually charge you prime plus 2%. The third way to access cash value in a policy is through the collateral loan, where you're going to assign the policy normally to a bank, to a third party, and in return, you get a loan from it. And the fourth way to access your policy is taking dividend in cash. And this is for par only, right? Dividend in cash options. It gets more popular, dividend in cash. And I'll stop here and explain why, because and let me know if you don't see my drawing on the screen. Because what happened, let me show you the difference between a G2 and a G3 policy. So assuming if you have an ACB, this is your amount of ACB in your policy. And this is your age right here. So if you start, when you see in G2 policy is this, you get an ACB growing as you're paying into your policy. And as you get older, your ACB usually hits zero around the age of 85, around-ish. Right? So this is G2. This is your generation 2. So before the policy sold before 2017. After 2017, what you have is something, I'm exaggerating for effect, okay? I'm exaggerating. The curve doesn't look this way at all, but I'm exaggerating for effect. This is your around age 90. So you have a higher ACB. Usually the curve looks more like this, okay? So what you have here is that for personally owned policies is actually a really good thing right now to take dividend in cash. Because what happens with dividend in cash, and that takes me to my next slide is when you take cash dividend, what is taxable in cash dividend is the excess of ACB, right? It's the excess of ACB. So since post 2017 product, you have a higher ACB tail, dividend in cash becomes less of a tax burden, right? And so it's bad in a corporation where you have your CDA, which isn't proportionally decreased by your ACB, but personal owned policy, dividend in cash might be a really good way to access liquidity in your policy. So and when you're consulting with a client and you're wondering what is the best way, well, the first thing you have to come in mind is the ease of access. Is it easy to take cash value out of the policy? Policy withdrawal, yeah. Policy loan, yeah. Dividend cash, yes. Collateral loan, not as easy, but I would argue that so many lenders nowadays are used to this concept, so it becomes more easy. So impact on policy. This is, a lot of people don't talk about it, but this is something I really like. Reduces cash or death benefit and ACB when you do a policy withdrawal, right? It's a partial surrender. Like if you have participating whole life, you're withdrawing, you're surrendering your paid up additional insurance. So the death benefit usually reduces by more than $1 of cash value. So this is something you need to watch out. Policy loan reduces your ACB, right? But here's the kicker. When you pay back the loan, it also increases your ACB as you're paying back the loan and interest. And also what the excess of your policy loan is taxable, but when you pay it back, you can get a tax deduction. So your policy loan is like a if I can put it this way, it's not the official term used, but I see it as like a temporary policy withdrawal, like a temporary surrender, right? You can take up to your ACB tax-free, excess of ACB is taxed, but when you pay it back, you get a deduction. So it's a temporary surrender, and collateral loan, there's no tax consequences usually. For the loan rate, I want to focus on that a bit. The loan rate, prime plus 2% with Sun Life for a policy loan right now, but your collateral loan is typically lower. Okay, I've seen a lot of collateral loan lately going in, especially in decreasing interest rate environments, they're closer to prime rate, right? Of course, depending on the lender and your situation, but getting very close to prime rate. In theory, this is what's been presented, but what happens in practice? How do you simulate it? How do you calculate it, right? Well, we actually have a calculator for it. So please let us know if you want us to run these numbers for you. So this is a wonderful case study. It's our SunPar Protector product, 20 pay. Annual deposit is their premium, 30,000. And your guaranteed death benefit is $1 million. We're doing current -1. This is an age 40 male, life expectancy, age 90. Your tax bracket is 50%. So we're going to compare everything, right? We're going to compare the IRR on premium paid after tax withdrawals and net death benefit. Because as you withdraw money, you actually increase your IRR, right? Your IRR is inflows, outflow, and time value. So as you're paying for the policy is cash outflow, you're paying into it. As you're taking it is inflow, and your death benefit is inflow. So that's what this is trying to say. So your original policy is this line is your top line here. This is your OG policy, if I can put it that way. And then you have policy. What's the second line at age 100? Bear with me. This is age 100. Life expectancy, we assume age 90, so the cutoff is here. If everyone uses age 85, then the cutoff is here. So it depends on when you die. When you ask me, what is the best way to withdraw money from my policy for retirement purposes? My answer is it depends when you die, right? So if you pass away at age 100, like if you don't touch your policy, you get the most back. If you're touching your policy, dividend in cash, look at this, is option number 2. And then what you have here, you have this little crossover point between a collateral loan and a policy withdrawal. And you have here is a policy loan. And the reason why the policy loan doesn't perform that well at age 100 is because we assume you're capitalizing your interest. So it's interest on interest, you're never paying it back, but that gets compounded. So that's why you have a very sharp drop right here, right? So when you compare all this, and if you're assuming a life expectancy at age 90, what are your top choices? Well, your collateral loan has a 3.86% IRR. Of course, the original policy is the best, and after is dividend in cash. So these are really different options you can consult with your clients and really help them understand what are the impact of each one. And really, this is I know this is mostly after sales services. You can have this conversation pre-sale, but after sales services is really important. You can generate more business by having this honest conversation, and I feel like these conversations add so much value for the client, especially around retirement age. The second chapter of my presentation, the second rethink idea, is how many things can you buy back and get all your money back in the end? Sorry, how many things can you buy and get all your money back at the end? So this is a very interesting product, right? I'm going to start us off with a quote. So the product is Sun Permanent Life with return premium on death. And the quote is, your worst competitor is day-to-day confusion. The time it takes everyone to figure out what to do and what not to do. The reason why we have this quote is that this product is the Sun Life version of a whole life / T100 hybrid. So what do we mean by that? It means that the illustration only has 3 columns. It's simple. There's guaranteed premium. There's guaranteed cash CSV, cash surrender value, and there's guaranteed death benefit. It's 3 lines, and every number on the illustration is contractually guaranteed. So that's what makes this product simple, which is a whole life / T100, because you do get a bit of cash value. It acts like a T100 and it's priced that way, and so on. But what makes this product interesting is the return of premium on death. I remember some carrier had this years ago in the market, then it wasn't profitable enough, so they stopped offering it. So right now, Sun Life is the only company left in the marketplace offering you a return premium on death on a life insurance policy. And this is how it works. This is available on a 15 pay. So this product has 10 pay, 15 pay, 20 pay, and life pay. Return premium on death is only available 15, 20, and 15 pay and 20 pay. I'm not sure on life pay. I'll have to double check on that. So this is assuming a 15 pay, male non-smoker, age 50. And here is the difference by adding return premium on death and not adding return premium on death, right? If you add return premium on death, you can actually start the policy at a lower death benefit. And then the return premium on death will grow your death benefit because it's a return of premium. Every dollar of premium you pay in grows your death benefit for $1. So it's dollar by dollar. And you end up with a higher death benefit. If you take the same premium and you don't choose return premium on death, well, you can start off with a higher death benefit, but then that levels off, right? So all of these values will be guaranteed in the illustration. So in this case, when someone's asking me, is it worth it? Well, my answer is still, it depends on when you pass away. Because if you look at the IRR and the difference from that case with return premium on death and without premium on death, if you pass away in the early years is negative, right? Without ROPD wins by 3.2%. It's not a lot, but still it wins. But starting from year 10 forward, the IRR on return premium on death is always higher, right? So this situation wins after from year 10 forward. I think the crossover point is somewhere around year 7 for an age 50, but I have to double check that. But yeah, so in my opinion, if you have term, if you're well insured, return premium on death is worth it. But there are a few caveats to this strategy. Okay, anything cannot be this amazing. There are a few caveats. Your client must be under age 50 and standard to get this. Okay. But that doesn't exclude smoker clients. Some smoker clients actually really enjoy this return premium on death because it makes their premium feels cheaper. They're paying an extra premium because they're a smoker. Well, they can kind of get it back through the death benefit. Yeah, so life pay is not there. So 15 pay and 20 pay only. And it's really aimed for client looking for simplicity. Sadly, I've had an advisor ask me, can age 51 backdate work? Maybe case by case is not a big chance. If you have that in mind, please let me know. I'll ask our product team to find out. So I have a question here. Does this product have guaranteed paid up? Um, uh, so yes, it does have guaranteed paid up because it's 10 pay, 15 pay, and 20 pay guaranteed. Um, so this is what the illustration will look like. If you still like the idea of a 10 pay, but you can't get return premium on death, what can you do? Well, you can use our Sun Permanent versus Sun Permanent comparison tool, and you can run the numbers. If you want to pay more premium, it's both $1 million face amount, but a guaranteed 10 pay, your premium's up way higher. If you're using if you're using the 10 pay, sorry, if you're using the 10 pay, sorry, your annual premium can be lower. If you're using the 15 pay, your annual premium can be higher with ROPD. But you have the IRR comparison where, and it still goes back to my answer, it depends on when you die. So you have the IRR benefit on the 10 pay, lower premium, no ROPD. You have a higher IRR in the beginning. But because you're adding ROPD and 15 pay, you're paying more into the policy, but you do get a IRR benefit for later years. So it goes back to the question, when is the client going to pass away? What type of situation do you want? What type of payment structure do you feel comfortable with? So it's really, you have to run with the numbers. Let us know if you need quotes on these comparisons. We're happy to run them. My third chapter of Rethink for today, and I'm just doing a time check, it's our CI, child CI policy. Because, Sun Life is one of the rare carriers where we have an independent child CI. We have a child term now. So we have everything, child par, child term, child CI. We have the whole package. And this is an independent child policy. And I just want to bring something up that is rarely talked about in the industry. Everyone knows that child CI has more illnesses covered. It's not expensive, it's really cheap. But what's important about child CI is the assistance the parents can get when you're taking care of a children. Other than the assistant, you get a kicker. And what do I mean by kicker? And I want to run a case study for you. This is a child CI. It's an age 5. And the parents purchased $1 million of T75 CI for this child. What happens if you can build in a lifetime of guarantee and flexibility of CI? CI doesn't have to be a sold and done product. It can be very flexible. So what happened is age 5, you buy the CI policy. Age 18, you have the option to add in long-term care conversion rider. So you don't have to choose that right away at age 5. At age 18, actually, you're going to get a notification from Sun Life and say, hey, do you want to add this rider? You say yes. And then what you do is this policy comes built in. You can build this in, return premium on cancellation and expiry. But you can choose the advanced option of that. So what does the advanced option of return premium on cancellation expiry do? At age 25, this child gets 70% of all premium paid today return. The policy remains in force. It remains in force. It doesn't change. Okay, so the policy remains in force. At age 25, you get 75% of your money back. Then you drag this out to age 40. At age 40, you're eligible for full return of premium. You can then decide at age 40, do you want to cancel this policy, take the remaining money back, or keep it running, right? If you haven't met your crossover point yet in your CI policy, you can keep it. Then at age 60, if you have chosen the long-term care conversion option, you can choose to fully convert or partially convert your CI policy into long-term care coverage. And Sun Life guarantees in the contract that we will maintain a long-term care product for these CI policies. And And also shout out to our long-term care, because we had 2 products, we canceled one, we still have 1 remaining independent long-term care policy left. So that is also an underserved needs in the Canadian marketplace. And I'll end here with my last chapter, right? The concept of vesting. I'm going to take a step back here. So what do I mean by concept of vesting? I mean for business owners, especially when you're talking about participating whole life with business owners. So this is, I'm going to end here as my last chapter. What do we mean by vested? Well, think about our SunPar accumulator product, right? This is what happens on the balance sheet of a business owner when they're thinking about insurance. Not necessarily the business owner, but at least the CFO, the chief financial officer, right? Or the accountant, or the lawyer who's the main advisor of the client, right? This is how they will look at the balance sheet. If you have a UL solution, let me draw this out. If you have a UL solution and you're paying annual premium into your policy, right? What happens is, yes, you get 0 cash flow the first year, you get a negative balance sheet the first year, and impact on income statement is a negative. When you pay in your second premium a year, when you still have 0 cash value, now you're negative 100,000 on your balance sheet, and you're another negative 50,000 on your income statement, right? So as your cash flow grows, it might not catch up to the impact on your balance sheet. So the impact on your balance sheet is, in most cases, negative. So when you have these scenarios running around in the industry, there's good and bad. The bad part is that people perceive insurance as a cost, as something that is actually not helpful for a business at all. It's showing red everywhere. But then some tax opportunities may arise when all these are red, right? So for this, really consult with your independent tax expert, but some tax opportunity may arise. So it's good and bad. Now, when you compare this to participating whole life, especially our accumulator products, same 50,000 premium a year, but the first year you're already having 43,000 of cash value, and your impact on your balance sheet is very minor, right? Your impact on income statement is very minor. But then as you advance, you have a break-even point at year 5, where the impacts becomes positive on both balance sheet and income statement. I just want to take a pause here and note that the impact of income statement is not about taxes, right? You're not going to be fiscally impacted this way when you have an insurance policy in your corporation, because the insurance policy is tax exempt when it grows in your corporation. This is just for illustration purposes. This is just to tell you how the policy is being perceived if you're a numbers person. So with participating whole life, the advantage is that because you have faster growth in your cash value, your balance sheet impacts becomes positive at year 5. And this can be perceived as a real asset in your corporation, as making your corporation more valuable. So it's really that when the philosophy behind my presentation today is about rethinking all these concepts. How does the math work? How does it intertwine with your clients, with your client's center of influences? If you want to continue to having this conversation, I'm happy to do so. And I think I'm running out of time. I'm 1 minute early. It's 4:29. So I'm going to give you back 1 minute.
Thanks, Yusudan. Great job. And thank you again on behalf of all of us at IDC Win. What an incredible day today was, with presentations from CPP Foresters, Avari, RBC, IA, The Edge Benefits, and of course the members of the IDC World Source team, Michael Gao, Vic Ray, and Nitin Bansal. Take care. Bye-bye.